Today, I'll be looking at the similarities between the current trading environment and what happened at the top in August 2023. And at the end, we'll talk about one key difference between the two periods as well. So let's start with the short term. We talked about this chart before. This is a 2-hour chart of the S&P 500 with a 14-period RSI here. Now, remember that we first started talking about this after the first few days of the big rally to start this extension where it was instantly overbought for the first time in a number of months. And we pointed to what happened back in the spring and summer, where the first time we had an overbought reading was right around where things broke out from the biggest pattern here. And that just led to a pretty substantial rally, of course, until the end of July, early August. And that was the first time that the indicator actually hit oversold levels back under 30. So really staying with this move until we got the oversold level allowed us to obviously profit a good amount of the time here. And so same type of thing happened now where after the first overbought reading, we saw additional readings that stayed near 70 or oscillated around that point until recently. And so just over the last few days, now the indicator is not quite oversold yet, but getting very close to being so. And of course, just a little bit more weakness would do the trick. So, the concern, of course, is that if that occurs, then this will mark a top like we had here, right? And so there are other charts as well that raise similar concerns. And so along the way from both periods, of course, we had the luxury of seeing breakouts work, right? We talked about how the whipsaws were less and allowed breakout zones not to be violated. And so one of the biggest breakouts we saw, of course, back in the springtime was at the end of May, which got us to the breakout target here between 4,500 and 4,600 in mid-July. And so one of the biggest breakouts from this current time was very similar, got to the first breakout right below 4,700 in the middle of December as well. And so, of course, right here, when that occurred, it was near the top, and the breakdown, of course, started soon thereafter. So, of course, we can make the case that that could happen again right now. Now, we'll get back to this at the end. So something else going on that we should not ignore. And so let's not forget, too, that each of these rallies began with the Zweig breadth thrust, right, which really kickstarted momentum, right? Both of them coming after two straight 1% declines. So momentum completely flipped. And of course, things have worked out as we thought they would. And anyone who followed these indicators as well, where it did kickstart the momentum, which then led to a more consistent uptrend. Same with here, even though this clearly is still pretty steep, things had slowed down from the initial 1% moves in 12 trading sessions. Now, the concern, of course, is that eventually momentum does fade and start to break down, which of course it did in August. That, of course, is the concern again currently. And so the other part, of course, is that we haven't had a drawdown of anything more than, say, 1 or 2% right now. And you look back over the last year of action, we know that the biggest drawdowns occurred during both corrective periods from the February top to the March low, and of course, from the July intraday high down to the October intraday low. And things, of course, change from pretty consistent uptrends to not. And of course, at some point, that's going to happen again. This can't continue like this with hardly any pullbacks whatsoever. And we could see the beginning stages of that right now. Again, not real surprise at all, just a matter of when that's going to happen. More importantly, what it looks like after things start to fall apart a bit more. And of course, let's not forget the fact that as the S&P was rolling over, it didn't do it in isolation. We saw the dollar start that pretty substantial rally, of course, that lasted for a number of months, really just coinciding completely with the breakdown in the S&P 500. Now, we did see the dollar put in a low about 2 weeks before the S&P put in a high. So it gives an indication here. Wasn't too much of a concern when that occurred, because we saw failed rally attempts in the dollar previously in 2023. And even though not many people were around to see it, in the week between Christmas and New Year's, the dollar put in another low and actually started to rally pretty substantially without the S&P doing much at all. And so now Needless to say, if this is the beginning stages of a more substantial rally, right, not a failed move like we saw here, that's going to be a headwind for risky assets. Of course, the S&P included in that. And so seasonality perspective, same type of thing, where we came into August knowing that you typically don't do that well and you're entering a period of typically higher volatility, which of course led to or added to the fact that the S&P was having trouble. Again, right now, again, no surprises. January, as we know, one of the worst months historically. In fact, going back over the last 20 years, is the only month out of the 12 with a win rate below 50%, and only one of 3 months with an average move below break even. And so, not surprised to see if things start to pull back a bit, and with everything else so extended that would happen around now. And then Ryan Dietrich of Carson Group put this on X a few days ago, talking about also that we are in an election year, and within election years, the first quarter tends to be weak as well. So it all kind of goes together from a seasonality perspective like that. And so all those, of course, are concerns that we could get a pullback greater than we had before. Now, there is one key difference from a chart perspective right now compared to what happened in August. Now, we talked about how back here, the S&P had just hit an upside target, from a May breakout. Now, that was the fourth upside target achieved during that time frame, which is obviously very bullish. But at the same time, once that bullish target got hit here, there were no other patterns from a bullish perspective in play, meaning that we had no more upside targets to key off of and really needed the market to pull back at some regard to form the next bullish pattern. Now, we saw instances of that. This one failed. This one failed. It wasn't until, of course, we came back in October for the next one to occur. But that's how things go sometimes. Now, right now, even though we had the breakout target hit up here, we saw before from a relatively smaller bullish perspective, there is a much bigger breakout still in effect, right? And so that was from what happened at the beginning to middle of December, which still has a target up above 5,000, which is about 6% away currently. And we still have about 3 or 4% leeway for the market to pull back. Now, could that get violated pretty easily? Yes, we've seen big down moves occur very frequently, and that could easily be taken out. But as of right now, it is not. And so if we do see a pullback, say 4 or 5% from the high, it would take us down to around this zone, right? This is where the slight trading range was from December. It was where top in September was around August. So I don't think it would surprise anyone if a pullback happens and we see some sort of stance around here. If that can occur again, this would stay in play. Now we have to be concerned that that may not happen, right? But considering the big run that we've had, the market can really make a higher low anywhere in here, and then start to construct an even bigger pattern that would potentially come into play later in the quarter, maybe into the year. So that's the scenario I'll be watching for over the next week or two. We'll be in touch along the way. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.